I'm at Fulbright. I'd like to thank everyone for attending this webinar. Indexing is an active decision. Um, I want to thank you for joining the North Carolina Association of CPAs Financial Planning um, group. And it indexing is an active decision. I'm at Fulbright. Jermaine is also a co-host, and we'll be working the session today. And as many of you know, the mission of our group is to provide an objective financial planning information to help you, your clients, and your family make better financial decisions. And we're thrilled to have Mary Phillips, Deputy Head of Portfolio Management with Dimensional Funds. Mary is also a member of the Investment Committee and Investment Research Committee at Dimensional. Mary, along with her colleagues, oversee the portfolio management team in North America, responsible for delivering Dimensional's U.S. and non-U.S. equity strategies. Mary is also involved in the design and implementation of new products and strategies, and frequently speaks with both prospects and clients on topics ranging from Dimensional's investment philosophy and process to customized solutions that the firm can provide to help clients achieve their goals. Mary previously worked as a portfolio manager at Russell Investments, where she designed and implemented derivative strategies for commingled funds and public and private pensions. Mary earned an MBA from the University of Chicago Booth School of Business, and she also holds the CFA designation and completed a BA in Business Administration at the University of Puget Sound. And now I will turn over to Mary, and she will enlighten you.
Sounds great. Thank you. I'm going to bring you everywhere with me. That was a very nice intro. I'm like, who is this person who's speaking? It sounds pretty smart. Well, thanks for coming today. I'll get into the presentation. If you're not familiar with Dimensional, we started in 1981. We manage about 780 billion in assets. Including 150 billion plus of that in active ETFs that we launched starting in 2020. We're the largest active ETF provider globally, and we are planning to keep it that way if we can. So with that, I'll get into our presentation. Right, this is the hardest part, is making sure I share the right screen. All right, can you see?
Yes.
Good. All right, thank you so much. All right, well, we're going to talk about today the decision, this decision of going active or passive in investments and looking under the hood for that decision. When we think about any type of investment that's made, there's a lot of decisions involved in it. Even if you're trying to hit the easy button and go with indexing, I'm here to tell you there's a lot of decisions being made within the index fund that you're invested in. And so we find it helpful. It's kind of funny. I started my career, I've worked in something indexing adjacent or done it myself my entire career. And when we came up with this presentation, I thought, who's going to want to hear this? Doesn't everybody know that? It turns out that's not true. For those of us who are sort of in the weeds on this stuff day to day, we're pretty used to it, but we found that a lot of people don't realize all the things happening in their index products. And so we want to bring that to light and then share things to consider when you're thinking about an index product versus an active product or something in the middle. Okay. So with that, I'll walk you through our agenda for today. We could think about index investment from a couple different angles. The first one is you and your clients. So as an investor, you are making even the decision to index and those decisions surrounding your choice can involve some active decisions, right? If you don't wait to copy exactly the weight of all the stocks in the world, you're suddenly making an active decision. The biggest one I see is overweighting the US, which has proven to be a great decision. But it's still an active decision, right? It's been a good one over the last 15 years or so. The next one are going to be active decisions by index providers. And I'll make a distinction here. There's index providers, and this is your S&P, right? MSCI, FTSE. So these are the companies that make an index. And their role in the industry is to collect which stocks follow their rules and publish an index for others to use. And that is their entire role. And they're going to be making money off of licensing that index to others. So you pay a fee and you can use their index. So that's the index provider. An index manager is going to be an asset manager. I think the ones you hear most commonly, like Vanguard or an iShare or something like that. That an index manager is going to run an index fund to track or copy the index that's provided by an index provider. So S&P provides the S&P 500 index. That's their role. The index manager is going to pay a fee to the provider. Okay, what are the top 500 stocks that are included in the S&P? It doesn't mean they're the top 500 in the country. And then track and basically copy whatever that index does to provide an index fund. Okay, so those are the different roles. And there's so many decisions made from the beginning to the end of that process that they can look fairly active. And I think it's worth understanding that decision making so that you know what's going on behind the investment. So first, we're going to think about your role as an investor. You're making active decisions, whether you think you are or not. One of the big ones is, what do you want exposure to? Which asset classes and investment styles? So as I said, I think one of the biggest macro decisions that an investor makes is, first, it's stocks versus bonds and any other more exotic asset classes. How much you're going to allocate to each of those groups. Then beyond that, it's what exposure do you want within it? If you're in the equity space, it's about 60% US weight and 40% non-US. If you're just to be completely passive. And I think for most people, 40% non-US sounds a little high. And so there's that first decision out of the gate to say, you know what, I think I should be a little bit lower at non-US. You've made an active decision. Then from there, you can think about styles. So I think folks say, oh, maybe I want a little bit more value stocks or growth stocks. Even if you use an index product, an index fund to express that viewpoint, you're still, if you're not equal between those things, you're making an active choice and a decision to say, I want more of one thing than the other, right? That's an active decision that is going to result in performance different from the market. And so that's the first layer there. The next one is which part, if you think about your whole portfolio, a lot of folks say, I'm going to do active over here and passive over there. So which exposures do you want to choose to index? I always find it interesting. People have this rule of thumb in their head that small caps and emerging markets are less efficient, and that's a better place to index. I would actually say they're more volatile, and it actually might be a better place to index. Have less volatile outcomes. But I think when people think about where am I going to get my, where should I go index or not? That's a big decision to make. And then which indexes and indexed products should you choose? So if you're choosing, you say, oh, I'm going to index my US large caps. Well, there's a lot of products out there. You can buy a Russell 1000 index product, S&P 500. I know there's also some providers use more bespoke indexes, which is kind of like a custom index. Or CRISP is another index provider that is used by Vanguard quite a bit. And so there's a choice there of saying, I want exposure to US large caps. Well, which index? You've made a decision then what you're going to get exposure through. And then finally, how do you evaluate your index product? I think a great, somewhat easy takeaway from this presentation, use a couple indexes or benchmarks to evaluate your index manager. So if you're selecting one index product, use a couple different indexes to evaluate its performance, because you can have a little bit more perspective on it. I would expect that your index product is going to match the index it's managed to, but you're not going to see the sort of active elements of that index unless you compare it to something else. Okay, so think about the benchmarks. Now, why would this be? So this colorful picture we're looking at kind of looks like a quilt. This is showing us, this is just a selection of which index you're going to use, and then to evaluate performance, or also if you're choosing index product, knowing that the index itself is not going to be one for one, they're all the same. So you're actually making active decision which one you want to invest in. So what we see here, the light blue is the S&P Small Cap 600 index. So 600 securities that are selected by the S&P committee. The Russell 2000 index, which is a fairly methodical process in terms of what is included in the Russell 2000. I take that first 1,000 stocks, that's the Russell 1000. The next 2,000 go in the Russell 2000 index. And then finally the CRSP, which is CRSP is short for Chicago Research into Security Prices. That is an organization that also creates indexes, and they have a U.S. small cap index. So the interesting thing to look at here is that the returns are not, these are all supposed to be small cap. The returns are all over the place year to year. Though they're going to kind of move together in some regards, but they're not going to be, they're not as consistent as you might think to say, well, they're all small cap. They should be somewhat similar. So most recently in 2023, you see the CRSP had an 18% return, and Russell 2000, 16.9, and then the small S&P 600, 16.1. So the difference from top to bottom is a 2% difference in return. So if you think, oh, well, I'm just getting small cap, I think if I know when I've had to explain performance to clients and I was 2% below their benchmark, I had a lot of questions to answer for them. Less questions when you outperform, but so something to think about. Well, geez, I'm tolerating that amount of difference in return, and I think I'm just taking the no decision path here in terms of indexing. Now, if you look over time, the biggest period here is going to be 2021 is a 12% difference between the highest and the lowest return security or index, just for small caps. So you see that S&P has a 26% return versus 14 for the Russell 2000. And there's a lot of construction that goes into these. That S&P 600 has a earnings screen on it that screens out a lot of low or negative earnings companies, whereas the other two indexes don't have that. But you're starting to wade into something that seems pretty active, right? That's a decision to make. Well, I'm not going to invest in these companies with negative earnings, which sounds okay at first blush, but they may end up being great companies and with a great return. So on average, the difference between the highest and the lowest small cap index here is just shy of 5%, 4.9%. So I would just say when you're thinking about which index product to use, and then I think the easier solution here is also just think about what benchmark you're going to choose. If you've already indexed your US small caps, look at all three indexes and see how your product is performing against each of those indexes to evaluate its performance. So you're really doing your due diligence on the product. Any questions at this point? Pause a little. Okay. You can always interrupt me. Okay, so that's one angle. The other part is when I think about, as an investor, I think one of the biggest things that drives the decision to index is the cost, which makes a lot of sense. Index products are very low cost. And I think we share that philosophy here at Dimensional, that we want to have low cost and think about the return to the investor net of the cost of paying us. Right. I think my favorite expression is your money is like a bar of soap. The more you touch it, the less there is. So you want to keep the cost low and keep the turnover low. I think, but when we're thinking about an index product, a lot of folks are thinking about the management fee. Management fee is certainly low, but you're not looking at the total picture of cost. The other costs and implementation are actually baked into the return of the index fund and then also into the index itself. And so that is, if you're comparing the fund to its index, you're kind of comparing two things that should look alike because they influence each other. Right? Trading of the stocks in the index is going to inherently change the index pricing as well. So we're going to focus here not on the management fee, which I think was pretty easy to observe and not much to talk about, and think about what are the implementation costs, the cost of trading. So going on the market to trade the securities and change which securities are in the index product, the style drift or opportunity cost. So I think especially for those investors who think, you know what, I do want a little bit more emphasis on a particular style. I want to emphasize value stocks more or small caps, but I'm going to do it in a cost-effective way through an index product. You are getting that partially, but you can actually dilute the decision by using an index product because there's a lot of style drift that can occur in those products. And then finally, taxes. I think some of the tax management that's possible in index product, well, it can be very efficient. There are more efficient ways to look at the taxes, okay, and manage those. So first, if we think about trading cost, what drives trading costs? Turnover, right? Just if you trade, then you're going to have some cost. Brokerage cost and then implicit trading cost. So brokerage cost is how much am I going to pay my broker to help me execute the order. The best way to reduce those is don't trade. If you don't trade, you don't have to pay someone to help you. And then finally, implicit trading cost. And if I think about costs as a whole, right, the first two, the brokerage costs and the cost of trading, turnover, that's the tip of the iceberg. If you think about implicit cost, that's the part of the iceberg under the water. It's way more, it's far outweighs the cost of paying a broker, but it's much harder to observe. And that's because it's baked into the price that you execute the stock at. So for example, if you were going out to trade a stock and you bid up or you pay a lot more and are willing to pay a high price, that's the price you pay, and it goes into into the return of your investment. It's hard to say, oh, they could have paid a lower price. It's hard to disentangle that. So we can look at, well, what is the structure behind the investment that would drive someone to pay a higher price? So let's think about this. If you were going to, let's see, what time of year is it? Oh, Halloween's coming up. Okay. I was thinking about Valentine's Day, but Halloween's probably a better one. So let's say everyone needs to go buy Halloween candy. This is your reminder, by the way. We're about a week out. I have a near 5-year-old, so I'm very aware. But if you're not, it's time to buy your Halloween candy. So I'll ask you guys a not trick question. Is it going to be more expensive to buy Halloween candy on October 30th or November 1st? It's going to be a lot more expensive on October 30th. If you want a deal, then go on November 1st, but you're going to disappoint a lot of kids coming to your house, right? Now, put aside the emotional part of Halloween. If everyone's trying to do the same thing at the same time, the price is going to be higher, right? That's same thing with Halloween candy. If everyone needs it on one day, then that's going to be when the price gets higher. So for an index product, they're going to say, well, which stocks are small cap and which ones are large cap on one day in June, right? So you're going to think about the Russell 2000 in June. And say, okay, on this particular day in June, we're going to change which stocks are included in the Russell 2000. And so that's what the index provider does. And the index provider their goal is to just represent the asset class and update that on whatever frequency they deem appropriate. So for Russell, it's annually. That will all change at 4 o'clock on the day that the index reconstitutes or rebalances. So some stocks are in the index and some of them go out. So if you're an index provider, or an index manager, how do you match the index? You want to sell all the stocks that are leaving the index at 4 o'clock on that day, and you want to buy all the ones that go in at 4 o'clock on that day. Okay, so how do you think that affects the prices of those stocks? Right? If everyone's got to sell it, it's going to get cheaper. If everyone's got to buy it, it's going to be more expensive, right? It's just like any other transaction we have out in the world. And I think the part that people miss about that is that the index itself is going to use the closing price that day to have the price of the index. And so if everybody needs to buy all the stocks going into the index and the price of the stocks is very high that day, the index itself is going to use that high price for its calculation. So if you're trying to say, did the index manager have a higher lower return than the index because it paid a lot for the stocks? Well, no, because that price is embedded in the index too, in the benchmark. So you're comparing, apples to apples basically, and you don't want to. You want to have a difference there in terms of comparison. If you want to say, did you get a good deal on candy? You want to compare your October 30th purchase to, say, the 29th, the 30th, and the 1st, right? And so you might say, geez, I looked pretty good versus the 29th, but not so good versus the 1st, right? And that will help you be a little more objective. So that is why the implicit costs are can be so expensive, but so hard to see. The other part of this is turnover. So turnover of index funds is low. It's very similar to what we do at Dimensional. So turnover, let's say 20% or so for a styled portfolio or style index. But most of that turnover is experienced on the days that the index reconstitutes or changes which stocks are in the index. So think about all the turnover happens on that one day. Versus what if you just say, I want to do a tiny bit every single day, and not have it all on one day. So it's you're going to spread out that cost of trading over a long period if you can spread out the turnover and have it be on each day. Now, an index manager cannot do that because that's going to introduce tracking error or just a different return in their portfolio versus the index that they're tracking. And so their turnover is all going to happen when the index changes its constituents or which stocks are included. So there can be different paths to getting to low turnover. It can all happen at once, or you can spread it all out over the year. I like to think of that. I signed up for the turkey trot for Thanksgiving, 5K. I haven't been running, just for confession time here. But I thought that signing up for the turkey trot would help me get motivated to exercise more. So I can either just say, I'm going to train all at once and go run 10 miles the week before Thanksgiving. Or I can work up to it, right? I started this week, I did a little running and walking for 2.5 miles. And I can increase that to be more running and less walking as I get closer to Thanksgiving, right? And I've spread out my training instead of just destroy my body in one day, right? So sort of similar when you think about how to run a portfolio. Do you want to spread out the costs, or do you want to concentrate it? I'm gonna pause there just in case.
Mary, I have a question while we're sort of talking about costs. I see a lot of people that they have Vanguard accounts, they have Schwab accounts, they got Fidelity accounts, what have you. Are there some hidden costs? If DFA goes into if there's a charge for buying it from your provider, that's not hidden. But does it make any difference whether DFA goes into a Vanguard portfolio or a Schwab or, in essence, do you all have a better relationship with one or the other out there who may have the money? I mean, all these young folks that seem to have turnover in jobs and everything are coming out of 401ks with with all these various providers, and I encourage diversifying your portfolio with various other people, various other providers. So hidden costs.
It's going to be specific. I think there's a combination there. I wouldn't say we don't try to recommend a particular provider just because it's going to be holistic for what your needs are and what you're trying to meet for your clients. I will say, I think what we do look at is trying to make sure that where we are accessible, that we're accessible in a lot of places and that we're always going to think about the end investor and like how much are they going to have to spend. So I'll give you a very esoteric example, but bear with me. Okay. There's a fee that gets charged on one platform, and I'm not going to be specific on platforms, and I'm pretty sure Evan, our salesperson here, is going to tell me I can't. But there's a platform that is out there that charges a fee based on the number of shares that you trade. And so if you trade 50 shares versus 100 shares, it's going to be cheaper to trade 50 shares. Okay, so because it's per share. So we made the decision in launching our ETFs, for example, to go with a higher share price. So if you have $100 to invest, hopefully you got more than that, but for the sake of example, if we listed at $25, you'd have to buy 4 shares. We listed at $50, so you need to buy 2 shares. Right, so it's a cheaper fee for an investor if we list at $50 versus 25. So that's the kind of thing that the detail that we're getting into when we're making decisions. But I think, Evan, maybe that's I think thinking through specific providers is definitely something we can have a more specific conversation about. Yeah, offline.
Would you see that in your literature? If as as an investor is investigating DFA, or would you see it in the the brokers' literature?
Brokers, actually. Is that
Okay.
right, Evan? All right. Yeah, it would definitely be on the broker side because
Yeah, you can go on Schwab, Fidelity, Vanguard, and they tell you what their fees are for trading mutual funds, ETF. Again, I'm not going to promote one versus another, but there is a provider that doesn't charge on ETF trades, but does charge on mutual fund trades. So, but that's all out there. You can look at Fidelity, Schwab, and Vanguard, and you can find that out. Some of them will, like say Schwab, may not charge on their index funds, their index mutual funds. So you have to read. You have to be active when you're going to do indexing and find this out.
Yeah, I do think one of the guiding principles that I have is there's no free lunch. And you sure hope there is, but there's no free lunch. And so if you're getting something, someone's making money. One way or another, whether you can see it or not. So for example, one of the ways that to profit if you're not charging a fee for a fund, or you've got an extremely low fee, is to do securities lending in that fund. And so, for example, you can lend out all the securities. You get the securities lending provider can get revenue. So if we do securities lending here, we lend out and there's revenue from lending the securities. Now, Dimensional, we think it's the client's money that is invested in stocks. It is their holdings. They get all the money back, the revenue from that activity, right? I know some of our competitors think, well, we've provided this service, we should keep some of the revenue, right? And so they may say the client gets 80% of the revenue and we're going to keep 20% of the revenue from securities lending. Well, if you've got a big enough portfolio, that can be a substantial revenue source for the asset manager, and they can charge a lower fee on the product. So that's a way you could say lower your management fee, but still profit from offering the product to investors. I think Morningstar actually picked that up and started reporting on it. So it's something that's more transparent. But I always think, am I getting too good of a deal here? What's the catch? There usually is one. Yeah. Okay, well, let's see here. So the other one, that's trading costs. We also I think the other one is just thinking about the style drift. I think when you're making a decision in the portfolio to focus on a particular style, you want us or your asset manager to be there to support you in that. So if you have overweighted small caps or value stocks or growth stocks, and you have an intention behind that, you're doing it because you're expecting a higher return from that part of the market. And what you want to do is really capture that if that comes to be true, right? If value stocks do great and you decided to have an overweight, you want to get the extra return associated with that. Now, an index fund is going to determine which stocks are value or growth either once, twice, or 4 times a year. So not very often. If the stocks that are value change a lot between the time that they say which stocks are value and when the return comes, you could miss out on the return because the stocks in the index haven't changed for 8, 12 months by the time the excess return comes from being in that part of the market. So this is something. Now, why does this happen? This is something that you think could be avoidable. I think part of it is the model of the industry where you have index providers are there to publish their indexes at some frequency, and they need to have a fairly affordable business for themselves, and then to charge out to index fund managers to do that. So they're going to say, we'll do it 4 times a year or 2 times a year. And then the index manager needs to be able to update and copy from that index at that frequency. And so if you think about the contrast to that, what we do at Dimensional is we do not follow an index. We have a little bit more discretion as a portfolio manager to say, I generally want to be in the value part of the market, and I'm going to figure out which stocks are no longer value each day and sell them. So it's just going to be a little bit every day versus doing it all at once. But you need an operation there of data that updates every day and of people who can look at the data and make a decision every day. And we have lots of computers that help us with that, so fear not, weird. But you've got to have people and data that is daily updating to be constant with prices to do that. And I think that that's sort of at odds with the model of indexing that exists currently, because it's a lot of information that has to go back and forth really quickly. So if you think about that, that's another good angle to think about in terms of cost. There's also opportunity costs involved.
Marion, let me ask
Yeah.
another question. You'll have to forgive me. I'm a loquacious Irishman, and I have trouble not having a lot of questions. How does your macro? I know I don't know how many you have, but you've got economists who are looking down the road. How does a macro optimism or disappointment in the future impact an index? A growth manager, are they going to shy away from growth, or are they going to sell NVIDIA when it's high, or Tesla or Apple or something like that, and buy growth maybe, but of a not a magnificent seven?
Yeah. So I would say a couple of things. One, an index and an index fund that's tracking the index is not going to update throughout the year based on opinion. They follow a methodology, and they call them a methodology, but it's basically a set of rules that are going to dictate which stocks are in the index or out. And some of them are more transparent than others. So Russell's initial foray into indexing was actually to go in the face of S&P, which tends to not be as transparent. So Russell, you can go download it, download their methodology online after this and read it, and probably get a good nap in because that's pretty rough to read. But it basically says, rank the stocks large to small based on their market cap. And the bottom 2,000 are going to be your small cap stocks, right? And your top 1,000 are large cap. And then they go through other metrics like price to book ratio, some cash flow metrics to say these are value and these are growth. And they split the whole universe in two, 50% value, 50% growth. Then at the end of June, they bucket into one or the other, and that's it for the year. They're not changing. All right, so what happens there is, I think one of the most extreme examples that we've seen is, remember in GameStop, I think it was 2020, when GameStop went up hundreds of percent, maybe thousands, I can't remember, but it went up a ton. for those of us, dimensional is active, although I will come back to that. We are active in that we say, well, that stock today, it's no longer a small cap stock, so we're going to go ahead and sell GameStop today. And thankfully with a great return. An index fund is actually going to continue buying GameStop that day because it's in their index. And they're not going to change if it's small or large until their next date that they reconstitute the index. So the index funds were out buying GameStop when it was up, several 100%. So I would say an index fund is really not going to have any opinion in it. Dimensional, I would say, is in between the traditional where there's economists and a macro view and an index fund. We actually do not have economists on staff at Dimensional. We trust that all that information gets into the price of stocks. And so, for example, and I promise you this is not going to be political, okay? What's the biggest economic political event coming up? We got election in 2 weeks, right? What are the odds right now? It's looking like a jump ball. Okay. I mean, just if you go out and look at Nate Silver and all the statistics, it's really hard to say who's going to win. Even if you feel it in your heart. I realize that's a different story. But from an economic standpoint, it's really hard to say, and it's a huge potential difference in the outcome, what will happen in the economy. So it's hard to price in and say what's going to happen. So I think the whole market right now is kind of not sure what to do. We don't know what the answer will be. So we're going to have, maybe on election day, we'll find out the winner, maybe not, maybe a couple days. Yeah, that's my thought too. We're not going to know enough in a second. But let's say there's going to be a day, hopefully somewhat soon after election day, where we know the result. At that point, there's new information that we're all going to experience together, and that everyone's going to need to get into the stock market really quickly because there's information about economic policy and different policies that are going to end up affecting the economy. So at that point, all that information is going to get in the market. I'm going to guess it's going to be a pretty volatile day or two in the market, at least, as everyone incorporates their new information and outlook based on who's in charge of the U.S. government. So just to give you an example of why we think we're going to just look at the price and the information's in the price, all those events are going to, that's a big event. There's all kinds of little events that also get into the price. So instead, what we like to do is say, let's use current prices every single day so that we're always current with the information that is in the prices. Rebalance your value portfolio every single day a tiny bit. Keep your costs down, keep your focus on value stocks with that. So we're kind of a hybrid in between the active and passive worlds in that regard. And no worries about questions. I think it makes it probably more fun for everybody instead of listening to me drone on for a full hour. So, all right, I am going to speed ahead here. So index providers is the next. This is the provider of an index. So your MSCI, FTSE, S&P. They're going to decide which countries and stocks to include, and then how often to change or reconstitute which stocks are in the index. And then when do they announce it? Because once they announce what's going to happen, this is kind of like if you went into a car dealership and said, I'm going to buy a car today. I want black on black, right? And I just imagine a bunch of car salespeople kind of going, all right, I want this guy, this gal. Let me go take that sale. So same thing with an index provider. They're going to announce what stocks are in and out on a particular day and say it's going to happen in the future. So it's sort of like announcing the trade ahead of time. It is. So I'll give you a big example from 2020, and then I'll give you the 2023, which is a bit more up to date. But Tesla has been one of the largest additions to the S&P 500 in recent memory. And it was added in 2020. So started the year at about $28 a share. And then it was already one of the largest companies, by far past the 500 mark for the US, but S&P has a committee and they decide when stocks will join the S&P 500. And it's some combination of earnings and I think some opinion or take about why it should be included, which is not transparent. It's not shared why it's in or out. why stocks are included. So start the year at $28 a share. Everyone is speculating that the Tesla will be added to the S&P 500, particularly as its price appreciates. S&P announces in November that Tesla will in fact be added to the S&P. At this point, Tesla is $136 a share. So it's up several hundred%. Between the announcement date and they said, hey, and this day in December, Tesla will be joining the S&P 500. So what does that mean? If you're running an S&P index fund, you're buying Tesla on that day. So they are telling to the world, hey, everybody, a lot of people are needing to buy Tesla on this day in December. And sure enough, what do you see with the price? It goes from $136 a share to $231 a share in a span of less than a month from announcement until getting added to the index. So just think about this is, if you had a manager that you said, hey, I just want to make sure you have large cap stocks, you'd assume they'd have Tesla in there, right? It's already a huge company, but they didn't. And then they say, we're going to go ahead and add it, but we're going to let everybody know before we go buy it. And then we're going to buy it. They missed a huge run up in one security because of those decisions. And to me, that looks like a pretty active decision. It's not a complete passive, I have no opinion and no impact on my investments because of this. I think a better choice would be start at the lower market cap, include mid caps, include small caps. You don't know which one's going to be the next Tesla. And then stay consistent in the exposure over time, right? So not having an index and having something a little bit more flexible, you can have these stocks that end up being the really rock star performers in the portfolio. Now, I did promise 2023. Similarly, there were 11 companies added to the S&P in 2023. A lot of these ones we were familiar with, Uber, Lululemon, I think one, the Airbnb, and the interesting one, Palo Alto Networks. I would have no idea what this was if we didn't use it here at Dimensional. It is how that we access our work from home. So if we're at home, we use this Palo Alto Networks to access our work computers and the network. This was actually in the waiting room for 8 years before getting added to the S&P. It was already one of the top 500 stocks. It did not get added to the S&P for 8 years and outperformed the S&P by 199% over that time period. So huge company, and why it didn't make it in is unbeknownst to those of us as investors. So just like to point out, I think a lot of us say, oh, S&P is the top 500 stocks in the US. Kind of, not completely.
Now, is there some sort of bias maybe with this committee that chooses? Nothing seems to be nonpartisan anymore, but
I'm sure. Yeah. It doesn't, I honestly, I think there's not a lot of transparency to it to say what's going on for it. I mean, it's been that way a long time though. So I wouldn't say this is there's probably bias everywhere, but like you're saying, but I know I worked at Russell early in my career, and I worked with the person who started the Russell indexes, actually, this guy named Kelly. And when he started them in the 80s and 90s, I think it was the 90s actually, when they started those indexes, part of the reason they started them is that they were having a hard time with S&P's committee, and they wanted something that was fully transparent because they were evaluating money managers against these indexes, and the indexes had a lot of sort of biased or different information included them that was not helpful to evaluating managers. So yeah, a little different.
Yeah, I wondered whether those people had full-time jobs at Morgan Stanley or Goldman Sachs or somebody, and they come together every so often and
Maybe
pick.
talk about it. Yeah, I know. It'd be an interesting committee to be part of, I'm sure. So as you may imagine, everybody knows you're going to buy the stock, or the S&P index funds are going to buy the stock. What happens to returns? Prior to being added, lots of positive performance. Afterwards, performance is not so great. Okay, so as you might imagine, there's price pressure prior to being added, and then that dissipates after being added. I am going to click ahead here in the interest of time to this guy. So this is a visual of, this is the 10 different US indexes. So US security indexes, S&P 500, Russell, CRISP, and the securities being added and deleted, what happens to their return relative to the index. The price goes up relative to the index. This is the day this index changes, which stocks are included, and then you see the price decrease. And so that's a typical effect. And I'm sorry, I'm gonna have to skip ahead that one. And then we'll go, but just to give you an idea, that's how indexes operate. You might think to yourself, well, the index providers must know this. Why don't they change how they're constructing the indexes? But I think that they view their role differently than they're not there to be the research arm of an asset manager. An index provider has a lot of different stakeholders and clients who use their product for different purposes. One of them is an index fund, but there's many others that I think all of us here use indexes, for example, as a benchmark. So we just want something to measure against when we look at performance, right? That's a different use case for an index. So the index providers have been quoted saying, the fiduciary duty is fundamentally at odds with the role of an index provider. It's not their job to have fiduciary duty and think about the investments that are happening because of their index. S&P takes it further to say their indexes are not intended to meet the investment objective. They don't consider the investment needs of those in the downstream investors. And in fact, S&P is not even necessarily aware of what those investment needs are. So the index provider, they're there to make an index, to represent an asset class for many purposes, one of which is an index fund, but they're not there just to produce the index as an investment product. I think that's not their intention, and it hasn't been. So finally, I'll talk about index managers and how they operate. Now, an index manager has an index provided from another company, and their job, the way they're evaluated, is to track the index to match it, right? So if you found an index manager who always outperformed their index, what is that going to look like? Tracking error, right? So outperforming your index, if you're an index manager, is a problem because you have tracking error. And I think the way to evaluate an index manager, I think most people would agree, look at two big metrics: tracking error, so how close they track the index, and what's the price. So if you get low tracking error at a good price, that's the passive choice. And so an index manager is just trying to copy what the index does when it does it. So they have to think about how to trade stocks coming in and out of that index, and including weight changes in the index, how to invest cash that comes out of corporate actions and other clients. So for example, how much you get cash in the day that GameStop is up hundreds of percent. What do you do with the cash? You buy everything in the index, including GameStop. Right. So if you think about how is an index manager going to make a decision, their decision is driven by tracking error, not return. And then finally, how much tracking error should you allow to save trading costs? Typically for an index manager, they're going to err on low tracking error over saving costs because that's how they're evaluated, right? You manage what gets measured. So if we think about what do we see in the market in prices around index reconstitutions to see how index managers are making decisions and trading changes in the index funds, what we're looking here is average trade volume for stocks going in or out of an index before and after the date that the index changes which stock is included, the reconstitution date. So you can see S&P, it's over 25 times daily volume, goes through the day that the index changes which stocks are included. Same thing. Sorry, thank you. Same thing for outside the US with EFI and emerging markets. So huge increase. You might say, well, sure, but at least during the day, maybe there's something different happening. So let's dial in. We're just going to look at the S&P 500 over the course of the day in 15-minute increments. Now, I'll remind you, the stocks change in the index at 4 o'clock Eastern. Which stocks are in and which stocks are out. So what time do you want to trade? 4 o'clock in the close. And so what do we see the activity of index managers indicate? We see that the average daily volume is pretty low and consistent throughout the day. You don't see a lot of impact. And when you get to the close, you're over 100 times daily volume. That means that everyone's just going to go into the close and get the closing price so that they match the index. The best way to get the closing price of the index is to be the index, to be the closing price. Doesn't matter if you get a good price, you just need to get the same price. I've traded this myself at a prior firm, so I've been there. All right, well, in conclusion, because I think we've got, I'm gonna skip ahead these complicated charts here. So there is a better way, and of course I'm a dimensional, so I have to tell you it's dimensional. But I really do believe that I started my career doing index management using derivatives, which I've spared talking to you about it today. We didn't have to get into that complicated derivative stuff, but I have been in the case where I've been the market, I've been the close when I'm trading, and you can drive the price and get it and have lower your tracking error. And I do think that that's a value for investors in that you don't have to have a lot of transparency into what the index manager is doing, or the index, because you know what you're going to get. However, I do challenge everybody to look a little bit deeper at their index provider, their index managers, to understand what they're doing, evaluate their performance, at the very least, evaluate against a couple of benchmarks. If you want to take it a step further, dimensional, I'd say we decided very intentionally not to index out of the gate. Our founders were they were part of the original index funds in the 70s and decided to go a different path, where we get to rebalance a little bit every day, stay focused on the asset classes we're providing, but also keep the costs low. And so there is a better way, and we've found that we've been able to outperform. I'd call your attention to the 20 years. Can you do something like that and still perform well? 92% of our equity funds have outperformed over the 20-year period, and just doing things a little bit different than an index fund, but capturing that return. So thank you for your time today. I did finish with 5 minutes remaining, so you can either wrap up your lunch or I'm happy to answer any remaining questions.
May I ask one more question?
Please.
I refer people to Morningstar as just good, from financial planning standpoint. Christine Benz, I think, is a great writer there. And you all have when you look at the accounts, you perform very well, and parent ratings and all of those things. It is. I assume that you would recommend them too, or maybe not. Or is there another, and if you're recommending people, because you can get a wealth of information for free on Morningstar. In the case, I'm in Wake County, North Carolina, and you can get Morningstar out of the library with your library card. Is there another source you might recommend to people, or is that about the best around? Non-partial information.
I will say I think Morningstar is pretty good. I mean, and you're right. It's definitely something that's really accessible. And I think one thing I like about their offering is that they make it straightforward for people to understand. I think it's so funny in this industry where kind of like going to the doctor.
Mary, is there a way you can turn your volume up?
Oh, you know what's funny? I've been
There
having
you
issues
go.
with this. Is that better? Okay.
Yes.
I had that yesterday too. No, I think Morningstar is a great service. And I like that they make it easy to read too for everybody. I think we all sit here and pore over this stuff and speak in sort of tongues, I think, sometimes when we talk about investing. But I think it's a good, accessible service for everyone. Beyond that, I mean, honestly, there are some free Bloomberg access. I mean, I look up portfolios on Bloomberg.com. But beyond that, I mean, Evan, do you have anything to add in terms of what you see?
Market Watch is another good free resource. Yahoo Finance. I think that they're all good for just finding out data. I'd be cautious of any market predictions or anything like that.
Yeah. Yep.
As
Yeah,
a
and
re-
fund recommendations. One thing that I see these US News and World Report, top 7 ETFs, and I'm like, for who? Depends on what you're trying to do. So yeah, I always am wary of the predictions. Think of your goals, or I always tell people, think of their goal first, and then think of how to achieve the goal, not look for the solution, then figure out your goals.
Okay. Jermaine, do you want to take us out?
I'll close it if I can find my information here. Let's see if I have it. Yes, I do. Okay, so we'd like you to save the date. Our next two sessions will be on a Thursday, not on a Tuesday because of the holidays. So our next session is November 14th, also at noon. We have a certified financial planner from the Charlotte area, Jenny Martella, and she's bringing along 3 people for a panel. These are people who deal in the long-term care area. So her topic is long-term care solutions and what the current trends are. So that will be really interesting to people. And then the session after that will also be a Thursday. It'll be December 5th at noon. Paula McMillan comes back. She's our resident expert on all things retirement planning and aging. But she will present Secure Tomorrow, Enjoy Today, and a financial roadmap for life's journey. So we want you to tune in. If you have some ideas of presentations that we can give in 2025, we're actually putting together our schedule for next year. We do a session every month for anywhere from investing, long-term care, estate planning, Social Security, cryptocurrency, you name it. If it's a financial planning topic, we come up with the speaker at a program to give you good information. So, Mary, thanks for doing this, and
Thank you, Mary.
Ed, thank you for arranging it, and Ed for being the speaker because I can't count on my internet these days. And thank you, everybody.
Today.
Yeah, today it worked the whole hour. I'm so pleased. So anyway, thank you everybody for being in this session. I appreciate it.